Hey everyone, it's August Aurora, and welcome back to the Deal Matrix channel. Today, we're diving into 1031 exchanges, a strategy to save real estate investors money in taxes. This lets you defer capital gains taxes when selling and reinvesting in a new property. We'll walk you through key steps and considerations. Stick around, and let's unlock the power of the 1031 exchange together. Before you get too excited about deferring taxes, make sure both your current property and the one you're eyeing qualify for the 1031 exchange. Both properties must be held for investment or business purposes. No using your primary residence for this strategy. The properties need to be like-kind, but this doesn't mean they have to be exactly the same. You could be swapping an apartment building for raw land, or even a retail space for a warehouse. When in doubt, consult with a qualified tax professional or a 1031 exchange specialist to ensure your properties meet the requirements. The 1031 exchange process isn't a DIY project, my friends. You'll need a trusted ally by your side, and that's where the qualified intermediary, or QI, comes in. The QI acts as a neutral third party, holding the proceeds from the sale of your relinquished property and facilitating the purchase of your replacement property. They ensure the entire transaction complies with IRS rules. Remember, you can't directly touch the money from the sale of your relinquished property. The QI handles all the funds, making sure everything stays above board and your tax-deferred status remains intact. Now comes the exciting part, selling that current property. As you list your property, remember the 1031 exchange timeline is ticking. Once you close, the 45-day and 180-day deadlines start. Everything must be structured correctly to maintain eligibility. Your agent and QI ensure documents and funds follow IRS regulations. Proceeds go to your QI, not your personal account. This is crucial for maintaining the tax-deferred status. With your relinquished property sold and the proceeds safely in the hands of your QI, the clock is ticking to identify your replacement property. The IRS gives you 45 days from the closing date of your sale to identify potential replacements. You can identify up to 3 potential replacement properties regardless of their value. This gives you some flexibility to explore different options. If you want to identify more than 3 properties, the combined fair market value can't exceed 200% of the sale price of your relinquished property. Follow these guidelines to ensure a smooth identification process. You've identified your dream replacement property, and now it's time to make it yours. You have 180 days from the sale of your relinquished property or the due date of your tax return, whichever comes first, to close on your replacement property. The closing process for your replacement property is just as crucial as the sale of your relinquished property. Your real estate agent and QI will ensure all the paperwork and fund transfers are aligned with IRS regulations. Once you close on your replacement property, congratulations. You've successfully completed a 1031 exchange and deferred those capital gains taxes. By reinvesting the proceeds from your sold property into a qualifying replacement and following IRS rules, you defer capital gains taxes. Reinvested money can generate greater returns over time. Remember, 1031 exchange defers, not eliminates taxes. Selling the replacement property later means facing capital gains taxes. Hopefully by then your portfolio has grown substantially. Remember, a 1031 exchange can be a powerful tool for growing your real estate portfolio, but it requires careful planning and strict adherence to IRS regulations. Consult with experienced tax advisors, real estate attorneys, and qualified intermediaries to ensure a smooth and successful exchange. Thanks for watching, and don't forget to like, subscribe, and hit the notification bell for more real estate investment tips.